Hello, everyone. Today, we're going to explore the concept of risk in depth, its definition, the different types of risks, what factors affect them, and how they play a crucial role in the financial world. So, what is risk? Risk, in the simplest terms, refers to the possibility of a negative outcome. It is the uncertainty regarding the results of a decision or an event. While we often think of risk in a negative light, it simply refers to the variance between expected and actual outcomes, whether those outcomes are positive or negative. We encounter risks every day, often without realizing it. When we drive, we understand there is a chance of a car accident. When we try new foods, we know there is a possibility they could be harmful. In fact, every decision we make carries some level of risk. Now, let's define risk. Risk is defined as the potential for an event or condition to occur that may have an effect, often negative, on a business's ability to meet its objectives. It is typically associated with variability or uncertainty in outcomes. In business and finance, risk is often measured as the potential for loss, harm, or damage, but it can also refer to the chance of gaining unexpected benefits or opportunities. Types of risk. Broadly speaking, there are two main categories of risk: systematic risk and unsystematic risk. Systematic risk refers to the risk that affects the entire market, or economy, rather than a specific company or industry. These risks are often unavoidable and include things like recessions, inflation, or changes in interest rates. Investors cannot fully eliminate systematic risk through diversification, because it impacts all investments. Unlike systematic risk, unsystematic risk is specific to a company or industry. This could be caused by factors such as poor management decisions, product recalls, or industry regulations. It may include risks like business risk and financial risk. What affects risks? There are several factors that influence the level and nature of risk. The first one is external factors. Risks can arise from external events like natural disasters, political instability, technological changes, and economic fluctuations. These factors can introduce uncertainty and impact the risk profile of businesses and individuals alike. The second factor is internal factors. Internal factors like management decisions, company policies, employee performance, and operational efficiency can also affect risk. For example, poor risk management strategies or weak internal controls can increase the likelihood of negative outcomes. The next one is market conditions. The overall condition of the market plays a large role in determining risk. During economic downturns, risk levels tend to rise as businesses face financial pressure. Conversely, periods of strong economic growth can reduce risk. The last factor is behavioral factors. The human element cannot be overlooked. The decisions made by investors, managers, and other key stakeholders based on their perceptions, biases, and emotions can impact how risks are taken and managed. Cognitive biases, such as overconfidence or fear, can lead to poor risk management. Let's go deeper and talk about financial risks. Starting with the basics. Financial risk refers to the possibility of losing money on an investment or business venture. In simple terms, it is the chance that things might not go as planned financially. There is more than one way a company can face financial risk. Therefore, it is a broad category of different risks. Here are some key financial risks: market risk, credit risk, interest rate risk, currency risk, inflation risk. Market risk arises from fluctuations in the prices of financial assets like stocks, bonds, and commodities. Factors such as interest rates, inflation, and global events can cause market risk. Credit risk involves the possibility that a borrower may default on a loan. This is particularly important in the lending industry, and financial institutions have to carefully assess the creditworthiness of borrowers to minimize this risk. Interest rate risk refers to the possibility that changes in interest rates will negatively affect the value of investments. For example, if you hold long-term bonds and interest rates rise, the value of your bonds may decline. Currency risk arises when companies or investors deal with assets in foreign currencies. Fluctuations in exchange rates can lead to financial losses if the value of a currency changes unfavorably. Inflation risk occurs when the value of money declines over time, causing the purchasing power of assets to decrease. Investors need to be aware of this risk when investing in long-term assets. Why financial risk matters. Understanding financial risk is crucial for both businesses and individuals. Here's why. For businesses, credit risk and operational risk can impact profitability. A company's ability to predict and control these risks influences its long-term success. If you are investing in stocks or bonds, market risk is something you will always need to consider. Knowing how to manage this risk helps investors avoid significant losses. By understanding financial risks, you can make decisions that minimize potential downsides and protect your financial future. Managing financial risk. Now let's talk about how we manage financial risk. Here are a few common methods businesses and individuals use to manage risk. Hedging. Hedging refers to a risk management strategy that is meant to protect future prices or to limit losses. It involves buying and selling investments to reduce the risk of losing an existing position. For example, if you have investments in stocks, you can use options or futures to protect against potential losses. Diversification. This is the strategy of spreading investments across various assets or sectors to reduce exposure to risk. The idea is that by holding a variety of investments, the poor performance of one investment potentially can be offset by the better performance of another, leading to a more consistent overall return. Insurance. Insurance is a financial arrangement that protects against the risk of loss or damage to assets, health, or life. It is a common way to mitigate operational risks. For example, businesses might insure their property or employees to protect against unforeseen losses. Additionally, businesses can mitigate financial risks through their operational practices. There are countless operating practices that managers can use to reduce the riskiness of their business. Examples include reviewing, analyzing, and improving their safety practices, using outside consultants to audit operational efficiencies, using robust financial planning methods, and diversifying the operations of the business. Now let's see a real-world example of financial risk management. Rolls-Royce Holdings plc has entered into a series of financial instruments to hedge its currency, interest rate, and commodity exposures. The group uses commodity swaps to manage its exposure to movements in the price of commodities, jet fuel, and base metals. To hedge the currency risk associated with a borrowing denominated in US dollars, the group has currency derivatives designated as part of fair value hedges. Rolls-Royce uses interest rate swaps and forward rate agreements to manage its exposure to movements in interest rates. The company reported mixed results of net fair value gains, £2,648 million, and losses, £4,420 million, in 2017 and 2016, respectively, when using various instruments to hedge its exposure to financial risks. In simple terms, these hedging strategies helped to make a profit of £2.6 billion in 2017, but they caused a loss of £4.4 billion in 2016. This shows that while these strategies can be effective, they can also be unpredictable and sometimes result in big losses if ineffective hedging strategies are employed. Thanks for watching this tutorial. If you found it helpful, do not forget to like and subscribe for more financial tips. See you next time.